Here's what's happening. U.S. homeowners are pulling their listings off the market at the fastest pace in nearly 8 years. Sellers aren't cutting prices. They're stepping back from the MLS entirely, and it's reshaping the housing inventory in ways headline numbers don't show. Today, I'm breaking down why that's happening, what it signals, and what it means for buyers, sellers, and investors. Let's get into it. Sellers always tell you the truth, not with their words, but with their behavior. And right now, the behavior is basically shouting. Nearly 85,000 homeowners took their homes off the market in September, up 28% from last year and the highest for that month since 2016. This isn't your typical pumpkin spice slowdown. About 70% of those homes had already been sitting for 60 days or more. Sellers listed, watched the crickets, didn't like the message, and chose to retreat instead of cut. One big reason, the math hurts. Mortgage rates are still floating in the mid to high sixes and often closer to 7% for actual borrowers. Payments are heavy, buyers are picky, and open houses look more like quiet art galleries than a bidding war battleground. So instead of dropping another $20,000 on paper, a lot of sellers take the listing down and tell themselves, we'll try again in spring when the vibes are better. Then there's the "and then what" problem. Inventory may be higher than a couple of years ago, but it's still nowhere near pre-2020 levels, and the options out there don't always match where sellers want to go or what they can afford. Plenty of owners look around, see nothing appealing, and say, why sell, just to be stuck? So they pivot, they hold the property, they rent it out, they become accidental landlords because the numbers finally pencil. And if you bought or refinanced during the peak frenzy of 2021-2023, you've got an extra reason to chill. A lot of those buyers locked in low rates, but at high prices. Roughly 15% of the homes delisted in September were at risk of selling below what the owner originally paid, the highest in about 5 years. Nobody wants to lock in a loss. So instead of taking the hit, owners choose to ride it out and let time, inflation, and wage growth slowly fix the problem. On the surface, you might think, if so many sellers are stepping back, doesn't that mean supply is collapsing? In certain price bands, yes, it feels tight. But the national numbers tell a weirder story. Active listings in October were up about 15% year over year and have been rising for nearly 2 straight years, pushing inventory to its highest point in about 5 years. Sounds like a loosening market until you look closer. A growing chunk of those listings are stale, price cut, or just sitting in MLS purgatory. The real inventory, the homes that are fairly priced and owned by people who actually need to sell, is still thin. In parts of Florida, Texas, and Phoenix, 7 to 8% of listings were delisted in a single month. Price cut, relist, delist, repeat. It's becoming a pattern, not a fluke. That's why buyers today get a split-screen experience. A well-priced, clean home in a good school zone still moves quickly, sometimes with multiple offers. But a mispriced, dated, odd layout home, it sits. It gathers dust, it racks up days on market, gets a couple of price cuts, then quietly disappears. This isn't the 2021 everything sells instantly market anymore. This market punishes delusion and rewards reality. So where are the buyers? They're out there, they're just choosy, cautious, and tired of paying record monthly payments for average homes. The typical U.S. home now spends around 63 days on market, up 5 days from last year, and marking the 19th straight month homes have taken longer to sell year over year. That's normal historically, but if you live through 2020 to 2022, it feels like slow motion. Price data tells the same story. National median list price sits around $424,200, up only 0.4% from a year ago, which is basically flat once you adjust for inflation. Price per square foot is even softer, especially in the South and West where frenzy-era gains are unwinding and sellers are relying more heavily on cuts to move inventory. And macro events are hitting certain markets harder than others. The federal government shutdown that began in October cooled demand in markets with large concentrations of federal workers, D.C., Virginia Beach, Oklahoma City. When paychecks are uncertain, let's shop for a house quickly becomes, let's wait and see. So instead of a national surge or slump, we get pockets of pause layered onto an already cautious market. Underneath it all sits the biggest force shaping today's housing market, the lock-in effect. Millions of households locked in 2 to 4% mortgages between 2020 and 2022. Now they're staring at 6 to 7% rates and saying, yeah, no. Over 80% of existing mortgage borrowers are at least 1 full percentage point below today's rates. Swapping a 3% mortgage for a 7% mortgage just to buy a similar home doesn't feel like a move up. It feels like taking a voluntary pay cut. And forecasts don't show an immediate escape route. Most major banks and housing economists expect 30-year mortgage rates to stay above 6% through most of 2025, maybe dipping in 2026 if inflation keeps trending down. Until then, plenty of potential movers are staying put, remodeling or reinventing their current home as their next home. That's why homeownership is becoming a longer-term relationship again. Instead of hopping houses every few years, owners are adapting what they already have, adding ADUs, finishing basements, renting out spare bedrooms, or keeping their old home as a rental when they upgrade. That behavior keeps listings down and the resale pipeline tight. Zoom out and the big picture becomes clearer. Housing is in a tug-of-war. The Fed's inflation stance keeps rates high, which slows demand. But household balance sheets, especially for existing homeowners, are still strong, which prevents the kind of forced selling that leads to big crashes. List prices are up nearly 37% since 2019, and price per square foot is up around 50%. Combine that with principal paydown, and the typical owner has a healthy equity cushion. J.P. Morgan calls this the wealth effect. High equity plus strong stock market equals we can wait this out. Policy chatter is loud, but action is limited. The Trump administration has floated ideas about incentivizing affordable housing, boosting construction, and tying immigration or labor policy to wages and housing pressure. But without concrete bills, timelines, or funding, none of that meaningfully changes 2025. Demographics add the next layer. Baby boomers still hold a massive share of U.S. housing, and their gradual downsizing will slowly add inventory over the next decade. Not a wave, more like a steady drip. On the other hand, millennials and early Gen Z are entering prime buying years, absorbing much of that supply, especially in markets where new construction can't keep up. Put it all together, and the short-term forecast is not exciting. Most institutions expect low single-digit national price growth in 2025 and 2026. No fireworks, no free falls, more like a slow, choppy wave than a boom or bust. So here's how to navigate it. If you're buying, this is a patient hunter market. Homes sit longer, inventory is higher than during the frenzy, and sellers are more flexible. But monthly payments are still steep. Your advantage is preparation. Get underwritten. Know your exact max comfortable payment. Target homes that have been on the market for 45 to 60 days. That's where deals, concessions, and rate buydowns live. If you're selling, price for the market you're in, not the one you wish you were in. Roughly 1 in 5 listings sees at least one price cut in many metros and more in parts of the South and West. Overpricing burns momentum. Clean prep, realistic pricing, and smart concessions beat let's test the market every time. If you're investing, fundamentals matter again. Gone are the days where you buy anything and watch it appreciate. Some Sunbelt and Mountain West metros now have more inventory and softer prices, which can create real opportunities if rents are stable and employment remains strong. But your deals must pencil at today's rates and today's rents. Anything else is bonus, not strategy. Patience, folks. Whether you're buying, selling, or investing, this market rewards people who move with intention, not impulse. If you're an investor, the slowdown might be the opportunity, not the warning sign. The market's not crashing, and it's not a seller's paradise either. It's a chess match. Smart, calm, strategic moves win. And that's the scoop for today. If you want the latest housing insights, breakdowns, and straight-up clarity, hit like, subscribe, and ring the bell here at Housing IQ. In a market full of noise, staying informed is your best edge. Catch you on the flip side.